If you're self-employed, a freelancer, or run your own small business, your health insurance situation just got significantly more complicated. Welcome to this explainer. Today, we're going to build a highly practical, step-by-step guide to help you navigate the completely shifting landscape of health insurance in 2026. The rules have fundamentally changed this year, and honestly, relying on what worked for you in 2024 or 2025 could end up costing you thousands.
Hey, before we jump right in, a quick but absolutely crucial disclaimer. I'm here to provide an explainer. I am not an authorized insurance dealer or financial advisor. The numbers and strategies we're looking at today are for educational purposes. So before making any final decisions regarding your health coverage or taxes, you should definitely talk to your insurer or a certified professional.
Here's what we're looking at today: the 2026 subsidy cliff, navigating the ACA Marketplace, off-exchange options, alternative plans, the Form 7026 tax break, and we'll wrap up with a step-by-step decision framework.
All right, part one, the 2026 subsidy cliff. We need to understand the massive changes to premium tax credits.
Let's start with the hard truth about 2026. Those enhanced subsidies that made plans, wonderfully affordable for the last few years, they've officially expired. And the frustration out there is just palpable. From 2021 through 2025, the government gave these tax credits a massive temporary boost and extended them to folks who normally wouldn't qualify. But as of January 1st, 2026, poof, vanished. Without warning, some self-employed workers have seen their health insurance premiums skyrocket by nearly 60% literally overnight. Imagine budgeting for a specific monthly expense and then getting hit with that.
We are officially back to the old rules. That smooth system where extra financial help just flowed across almost all income levels? Gone. For 2026, the dreaded subsidy cliff has returned in full force, and strict income cutoffs are the law of the land once again.
So the absolutely crucial thing to keep in your head right now is that 400% number. Under these newly returned rules, if your household income goes even a hair over 400% of the federal poverty level, your subsidy doesn't just, gradually taper off. Nope, it drops instantly and completely to zero. You literally fall right off the cliff. To put some actual dollars to that percentage, depending on your exact state's calculations, that cliff sits somewhere between $60,000 and $66,000 for a single person. For a family of four, it's roughly $128,000. If you're a freelancer and you cross that line by even one single dollar, bam, you are suddenly paying full retail price for your insurance. And since freelance income bounces around so much, a really good quarter could accidentally push you right off that cliff.
But hold on, don't panic just yet. Here is your lifeline. Your subsidy is based on your net business income after all your business deductions. It is not based on your gross revenue. So many freelancers just look at their top-line revenue and immediately assume, well, I'm priced out, before they actually run the real numbers with their deductions factored in.
Moving on to part two, navigating the ACA Marketplace, and why HealthCare.gov is still your default best starting point.
Let's look at how this builds into your actual shopping strategy. Despite the return of that subsidy cliff we just talked about, the ACA Marketplace remains the absolute best default starting option for most self-employed folks. Why? Because it's literally the only place you can get those premium tax credits. The financial gap here is just staggering. We are talking about the difference between paying an average of $619 a month at full retail price versus $106 a month on average if you get a subsidy. That $500 a month gap is exactly why you have to check your eligibility, even if you feel like you might be close to the cliff.
When you shop the marketplace, you're going to see familiar names fighting for your business. You've got Blue Cross Blue Shield offering the widest access nationwide, Ambetter standing out as a strong budget-friendly option in 29 states, and Oscar Health, which is fantastic if you want a really modern tech-forward app and telehealth experience. Plus, you have solid regional heavyweights like Molina, United Healthcare, Aetna, and Cigna. Basically, you are not settling for second-tier coverage here. Here's a super simple rule of thumb to keep in your back pocket. If you calculate your net income and find out you do qualify for subsidies, a silver plan is almost always going to be your best value. Why? Because silver plans unlock extra cost-sharing reductions if you earn under a certain amount. But actually, scratch that. If you don't qualify for subsidies at all and you're in pretty good health, stepping down to a bronze plan might make a lot more sense just to keep that monthly premium in check.
All right, part three, off-exchange options. We're talking private PPO plans for higher earners and frequent travelers.
But what happens if you run your net income and you really do push over that 400% cliff? Well, you aren't forced to buy through the government marketplace if you aren't getting a discount. If you're paying full price anyway, you should absolutely look at off-exchange private PPOs. See, over 80% of marketplace plans are HMOs or EPOs, meaning they have really tight, localized networks. By going completely off the exchange and buying directly from national carriers, you get so much more provider flexibility. This is a total game changer if you travel a lot for freelance work, operate across state lines, or if you absolutely must keep a specific specialist without jumping through referral hoops. Sure, a 2026 Silver PPO averages around $789 a month compared to a cheaper EPO at $676, but for high-earning professionals, that flexibility is often completely worth the premium.
That brings us to Part 4, Alternative Plans, exploring health sharing, short-term plans, and hybrid models.
Now, if you're priced totally out of subsidies, you're relatively healthy, and those PPO premiums we just looked at are making your eyes water, there are 3 alternative paths. But listen, you have to go into these with your eyes wide open. First up, health sharing ministries. This is where members pool their money to cover each other's bills. It's definitely cheaper, but the massive glaring caveat here is that it is not regulated insurance. They can and absolutely do deny claims, especially for pre-existing conditions. Second, short-term medical plans. These are great as a fast, cheap bridge between jobs, but they often exclude major categories of care, and they aren't guaranteed to renew. Finally, the DIY hybrid. Direct primary care combined with a high-deductible health plan and a health savings account. You pay a flat membership for unlimited primary care and then only use the insurance for total catastrophes. And a really great bonus for 2026, all Bronze Marketplace plans are now automatically HSA compatible. Just remember, these alternative paths are definitely best for healthy folks with a high-risk tolerance.
Part 5. The Form 7026 Tax Break. This is the deduction most self-employed workers completely miss.
Let's pivot for a second to a financial tool built directly into the tax code that can honestly alter your entire strategy. Enter IRS Form 7026. This allows self-employed individuals, assuming you aren't eligible for a spouse's employer plan, to deduct 100% of the health insurance premiums you actually pay out of pocket. And the absolute best part, it's an above-the-line business expense. You don't even have to itemize your taxes to take advantage of this. It just directly lowers your taxable income. Now, the reason Form 7026 is so incredibly powerful is that it creates this amazing compounding effect. Because this above-the-line deduction actually lowers your modified adjusted gross income, or your MAGI, it can literally help you drop back below that 400% cliff and qualify for better subsidies the following year. How cool is that? Just a quick note though, you can only deduct the part you pay out of pocket, not the subsidized portion, and it all gets reconciled at tax time on Form 8962.
Finally, Part 6, your step-by-step framework, the ultimate decision tree to choose your 2026 plan.
Let's tie all of this together into a really clean, actionable framework you can use right after this explainer is over. Just follow these 3 steps. Step 1. Always calculate your net business income after deductions. Do not use your gross revenue. Step 2. Take that net income and run it straight through the government subsidy calculator on HealthCare.gov. Seriously, check it even if you're absolutely convinced you make too much. Step 3. Follow the logic. If you get a subsidy, lock in a silver plan. If you get 0 subsidy and you're healthy, start comparing those off-exchange private PPOs against the alternative DIY hybrid models we just discussed. Okay, one extremely important logistical note before we wrap things up. Open enrollment for 2026 actually closed in most states on January 15th. That means if you miss that window, you can't just log on and buy a plan today. You'll now need a qualifying life event, things like losing your previous coverage, getting married, or having a baby, to trigger a special enrollment period. If you have a gap right now, a short-term plan might literally be your only temporary bridge until you qualify.
The single biggest mistake self-employed people make isn't picking the wrong plan, it's not running the numbers at all and just guessing based on some scary headline premium. So I'm going to leave you with this final thought to chew on. What is your real calculated net income right now? And how much money are you potentially leaving on the table by not checking your subsidy eligibility today? Don't let the 2026 subsidy cliff catch you off guard, guys. Run the numbers, protect your health, and protect your wallet.